because of the supply-demand gap, I see raw material prices continuing to rise.
I think sector specialists are very bullish. So everyone that is already there, the few of us that survived now through this decade, are very, very bullish and investing in this.
The capital going in, has to be conscious of the long-term element of that investment and the price volatility that also comes with that space.
We still see a huge supply gap, particularly outside of China.
If these OEMs, the Western OEMs, would actually go in as limited partners into private equity funds that have the skill set and have the deal flow and know how to take these projects forward, the supply side could be substantially stimulated.
So hello to everyone tuning in to this webinar brought to you by Assay Live. Today's discussion centers on the investment thesis for battery materials and the hidden economics of electric vehicles. After a recent energy crisis and the looming COP26 meeting, these topics are obviously front of mind for investors, business leaders, and politicians alike. But thankfully today, we're without any politicians on our panel. We'll be getting straight into concise and straightforward answers from our group of investors, analysts, and metallurgy experts. So without further ado, I'd like to introduce our speakers in no particular order. Milan Thakore, who's Principal Analyst at Johnson Matthey, Matt Fernley, Head of Research at Westbeck Walter Fund, and also founder of Battery Materials Review, Aline Carnizello, Portfolio Manager at Parla Investments, Erez Ishalov, Managing Director of Traxys Battery Holdings, and Marcos Camus, CEO of Voss Asset Management. A warm welcome to all of you, and thanks for giving your time to provide some feedback today. I wanted to frame the start by bringing up a post that I'd seen in the media just today, perhaps it came out earlier this week, around how the Volkswagen's chairman of the board had released on social media the number of models that had come to light around the total cost savings of owning an EV vehicle, a Volkswagen EV vehicle, are so much significantly better than owning one of their ICE vehicles now. It's quite significant that that's come out from the chairman directly himself. The data was gathered by an auto magazine, a German auto magazine, but it speaks volumes of what we're going to be discussing right now. So I'd like to ask the panel first off, are we all in agreement on the EV sales penetration rate continuing this hockey stick based on what we already know about the input material supply risks? So that's a quite difficult one, but an interesting one to get some discourse going as we start with. Marcos, maybe I could start with you first, as this is the first time we've had you involved in one of our webinars. I know you'll be coming at this particularly from more of a PE view with nickel very much front of mind, but let's dig into this on the EV side of things and how you see that from where you sit.
Thank you very much, and thank you for having me on this panel. I think the question is very pertinent, and it's something that is very front of mind on all of us and all investors in the space. From my perspective, as a private equity investor in natural resources, we certainly see that EV penetration and the growth of this market is on a trajectory that is certainly from a commercial and let's say policy perspective very stable. But we have identified and we see the gaps in resources where we are particularly active in order to meet that future demand of cars and of course battery materials to fit into this space. So while I think that the short-term sales projections are supported by the availability of materials, even though there are challenges in logistics and other parts of the supply chain, we feel that long-term, without significant investments, the raw material side of it will certainly be challenging.
Yeah, certainly. And then if you add on to that sort of the looming, the energy crisis that we've just seen, and then also, things like the semiconductor shortages, it's going to add fuel to this fire, if you see what I mean. But you see those very much as a sort of short-term issue, and the raw material inputs are much further out, or do you see them fairly near term in terms of becoming an issue?
Well, it really depends on the horizon we're talking about. I think the logistics and supply chain issues, without being an expert, I feel that they will be addressed in the, let's say, relatively short-term future. However, when it comes to the material side, I think in, let's say, 5 to 8 years, we will start seeing shortages without significant investment.
Aline, may I turn to you and get your view? Obviously, often speak with us on this panel, and we're always mentioning the sensational growth rates. But do you see any change in your outlook based on what's happened this year, or some of the near-term challenges that we've seen, such as this energy crisis in Europe?
I think there will be a lot more short-term disruption that we are used to in supply chain. I think overall the inflation backdrop is going to be a different one than that is in the last decade. But I think the medium-term trajectory is actually growing faster, not slower, and that remains the case. So I think it is supportive. We still quite believe these vehicles are coming online. They're coming faster than the street has the numbers. It's going to be a question of at what price, for sure, if we remain underinvesting on the supply chain.
Yeah. So do you think that price is going to sort of go down the chain to the consumer? Thinking back to what I was saying about the Volkswagen statement around it being cheaper to run, certainly maybe not purchase, but to run an electric vehicle. Do you think that the purchase price is still going to be holding things up because of these raw material costs, these input costs? They're just so expensive.
Well, unfortunately, I think the answer is yes and no. I think it is a comparable calculation, right? So is it going to be more expensive? In my opinion, I'm very concerned for the trajectory of the inflation and underinvestment we're doing on the hydrocarbon side as well. So I think, is it going to be more expensive? I think the answer is yes. Is it going to be less effective than the hydro solution? I don't think so, because I think, if you look into the balance of the oil market as well, we've been underinvesting there as well. So oil staying higher for longer, and these metals staying, the input cost of these metals rising, and at the end vehicle becoming more expensive, but still at parity is a scenario that I think is the base case that we have to take.
Yep. Okay, Matt, can I turn to you? What's your take on the EV sales penetration rate continuing this hockey stick?
I mean, I think what worries me, and Aline alluded to it, is the price of the battery within the vehicle. If you look at the mass market in Europe for ICEs, mass market prices are around about £15,000 to £20,000, and the median price for electric vehicles is currently around about 30,000. Now, that's obviously dependent on what chemistry the battery is, and what sort of parameters you're happy to accept in your electric vehicle. If perhaps you're able to accept slightly lower ranges, then perhaps you can have a cheaper battery within your vehicle. So these are things that have to be traded off. And then obviously also with regards to the operating costs, I think it's something like 20% of owners in Europe, and I think 40 to 50% of owners in the US buy their vehicles on contract or on loan. So if you lump in the higher upfront cost of the EV in there, then you are looking at potentially more expensive operating costs going forward. So I think the industry really needs to find a way to back out the cost of the battery, because I fully agree with Aline, because of the supply-demand gap, I see raw material prices continuing to rise. So the auto industry needs to find an ownership model that leaves consumers not being sort of stuck with the price of the battery and the battery raw materials within that. Having said that, at the end of the life of the EV, however long that is, 10 years, 15 years, you then have a substantially higher residual value in your vehicle. because of the value of the raw materials. So, there is a trade-off at the end of life, as well as the higher upfront cost at the beginning of life.
Yeah, certainly. Very good points. Milan, do you have anything in your projections that there's perhaps in agreement or different from what we've already said?
Yeah, I think, well, this year's been pretty impressive, actually. I think most have been surprised on the upside. Most forecast around 4 to 5 million BEV, PHEV sales for the year globally have now been completely surpassed, and we're looking at around 6 million for the year. That's an increase of 1 million electric vehicles. That's no small feat. And when I was on the panel last year, we were wondering, is there going to be a lot of pent-up demand? Is that what we're seeing now? I think otherwise, actually, we are seeing more affordable, still fairly expensive, but more affordable electric vehicles on the market, a lot more models. The EV has entered the mainstream in terms of, people knowing what an EV is, knowing how far it will go. And, if we look to China, arguably the largest EV market, the monthly sales penetration numbers there are phenomenal, actually. We're getting to, on a monthly basis, over 20% NEV penetration.
Are there still subsidies there? Sorry to add, in China for EV sales?
What was that, sorry?
There's still subsidies on that, though. Is that maybe helping inflate or keep those prices high in terms?
The subsidies are there, but they're coming down over time. And to be honest, some of the best-selling EV in China is a very small EV. I'm not sure if it receives any subsidies, to be honest. It's a sub $5,000 EV, a tiny little car, but that's the most popular one. And actually, that 20% NEV penetration is what China was targeting for 2025. Now, the average for this year is not going to be above 20% because it was much lower in January. But most certainly China will reach that ahead of its 2025 target, and that's generally what we're seeing across the board. We're underestimating EV uptake. So on that basis, you'd think, the ambitious government targets, OEM targets might be achievable, but we do have to take a step back and think of the supply chain, like JB Strobel said the other day. Make sure you do the math when it comes to the supply chain, and I guess we'll discuss that a lot more. But when we factor all of that in at Johnson Matthey, we expect around 30% BEV sales by 2030. That's our in-house forecast. So I'd be interested to see what other panelists expect.
30% globally or
globally, yeah.
That's interesting. Is LFP and these technologies coming through? Is that what's changing it? Is the breadth of battery chemistries available what's really helping this acceleration? Are people going to be content with that as the sort of is that the model that's seeing the scale globally that people that societies need?
I think just briefly on that, and I'll let the other panelists.
Yeah, that's right.
I think a wide variety of technologies will be critical. We can't get higher rates of EV penetration just by using one cathode chemistry and just by using one battery type. So yeah, we certainly expect there to be a range of chemistries and battery types going forward.
Erez, let me bring you in here.
Yeah.
Thanks. So do you have some more context to add on you as equally bullish? Do you like the 30% penetration rate, sales rate?
Yeah, listen, I think that, the main difference is, I think we already touched in previous panels from where we were a few years ago in these discussions, is that, we were concerned when we were talking about adoption rates, we were concerned about the demand side. Now we're mainly concerned about the hiccups on the supply side. And these hiccups, I guess, are part of the investment thesis for Traxys, Palantir's Traxys, for Pala, for everyone here who's an investor, and and is making their contribution to bridge this gap. So it's definitely it's not a futuristic utopia. We're way into the mainstream now. Just touching on a few points that my colleagues here have made about total cost of ownership, etc. Just want to remind everyone that two things. One is that there's also going to be a substantial demand increase on the energy storage system side, stationary storage for renewable energy. So that's another sort of vector pressing from the demand side on this very constrained supply side. And partially, perhaps, at least on the EV, the solution may, to some extent, be connected to when we were talking about the mobility revolution a few years ago. To remind everyone, it was electric, shared, and autonomous. It was this tripod. And perhaps the shared is some kind of a vector that reduces demand of EVs per capita or of hardware per consumer of mobility as a service will slightly offset that, and some model perhaps also dealing with the fact that you can reuse some of the cells and use them in bikes and electric bikes, etc., and that there's a recycling horizon for these materials, which we in Traxys believe in, and we invested in life cycle, so we're strategic partners there. So it's definitely something that we believe in. Going back to, I think, what Milan said, there is no one solution. I mean, everything is moving in parallel to some extent. It's a bit of a Japanese Kaizen effort. We'll be doing everything. We'll be recycling, and we will be more efficient on our primary extraction. And hopefully at some point, the very underinvested upstream and midstream, chasing the vast investments in the downstream, will become robust enough to provide more solutions. And we'll have chemistries that are tailored to the application. And between all of that, I'm actually optimistic. We might have some hiccups and some issues along the way, but come 2030, 2035, I think we'll all be, breathing cleaner air and having less noise in our CBDs, and then things will be much better. So as an earthling, I'm optimistic.
That's good to hear. And I just want to sort of play devil's advocate to that on a point that was raised by someone in the audience as we were going through those. And if anyone else wants to raise a question, by the way, there's a Q&A tab at the bottom where you can submit, and I'll try and get through those as we go. Is coming to the infrastructure side, is the infrastructure ready to support even the lower case of the EV penetration that we've been talking about? Let's think about, Texas and charging infrastructure, the grid in general, and then the inputs to the grid. This broadens from the EV debate into the decarbonisation debate now, and then we're hinging on the sort of the energy crisis that we're seeing in Europe with gas, and then the baseload power question as well. China switching back to coal, even though it seemed to be moving away from coal, etc. Just to play devil's advocate on your point around the cleaner air, yes, maybe in cities with EVs, but how's the infrastructure, the whole equation going to come together on an infrastructure level?
I think it's actually not. I remain optimistic, like Eris.
Yeah.
Typically things is, for example, just the public filings of the European power companies and how much they're investing on the grid. Historically, it's a super interesting chart. They have been decreasing 2-3% a year on the investment on the grid infrastructure, not power generation, but also the infrastructure. And now with the European Green Plan, they're going to increase 20% in the next 4 years. So the investments are already there in that sense in Europe. Other places will lag behind, but you're seeing that, the whole infrastructure is adjusting. There's also the fact that, not all of these vehicles are going to be charged in a gas station as if, a fuel-based vehicle. A lot of these would be charged in their homes and in the non-peak hours, and it actually will help us move out energy consumption in that sense. So it's not going to be all additional energy at peak hours in a gas station-like scenario. I think a lot of this actually is move out there and improves the efficiency of the current energy that we have. So a combination between these three factors, I remain optimistic as well that we'll get there. US is a little bit behind, but there's similar deals happening at the moment with the infrastructure package Biden is putting in place. The whole EV infrastructure is quite big within that, and once it moves fast.
Certainly. Anyone else got thoughts on the infrastructural challenge and meeting those extra power demands and electricity demands?
Well, I would just say that certainly the EV charging infrastructure is starting to be there. It's certainly not all there. Where it is concentrated is in cities. So a bit difficult for any of us to say because nobody's really travelled for the last couple of years. But I certainly know that in London, for instance, there's pretty reasonable charging infrastructure every couple of blocks within central London. There's less charging infrastructure outside the big cities, but as Aline said, people will start to focus on home charging, I think, more where they've got houses rather than flats and apartments. So, I'm less worried about that. That's certainly in Europe. As Aline said, some regions are lagging, but they will pick up. But I think that the industry knows that EV charging infrastructure is absolutely core to the EV story. Governments know, they've made funds available for spending on infrastructure. So I'm not too worried about it. I think there are other areas of the supply chain that I'm more worried about.
Go on, please. Yeah.
Well, I'm sure we'll come on to talk about it later, but with regards to the raw material supply chain, I'm very, very concerned. Not just in, the more metallic battery raw materials, but also some of the chemicals that are associated with manufacturing electrolytes and whatnot. So, there are quite substantial gaps in the investment. I mean, at the moment, the downstream end of the industry is raising capital at 10 times the rate that the upstream end of the industry is raising it at. And, as we all know, it takes probably 1 to 3 years to build a battery factory, but it can take, between 4 and 10 years to build a mine. So, we really are potentially building up quite a significant structural deficit for just down the road, which is quite concerning.
Massively. Okay, we'll come on to that in a sec. I just wanted to ask you, Erez, about your take on the infrastructure spend from the US and the Biden administration. We did touch on this when we spoke just a few weeks ago, but is there an update there that you could share with this audience around how much the US is spending on infrastructure and how much better it's going to get for this energy transition?
We're still all watching the news here. I have no special connections with Capitol Hill or on Pennsylvania Avenue, so they're still negotiating. And I think the wild card is actually that it looks like, for political reasons that have to do with the coal mining states, some of the support for renewable energy actually as a substitute for coal-fired might be delayed. But I do think that in all versions of the bill, the support for R&D on the BEV side and everything that has to do with going electric, at least on the downstream side, is there, and the support for charging infrastructure is there. I assume there's a bit of room to negotiate and trim some of the numbers that have to do with railways, with roads, with everything that's really the brick and mortar physical infrastructure. What I'm concerned about is that if this bill ends up without a very clear signal that the U.S. is going renewable, and then I'm not sure what it's gonna look like in Glasgow. It might have some ripple effects that could be negative, but hopefully some kind of an equilibrium will be found to help phase out in a humane way this whole supply chain and mainly the human aspects that have to do with people that them and their family rely on the coal business, let's call it, and find alternatives and solutions to solve the demographic and sociological and socioeconomic issues without hampering the at the end of the day inevitable transition to renewable. So it's politics, and politics are always complicated, especially in such a big democracy. And we're just all watching the news and hoping that the right solution would be found, because I don't think it will be a good signal coming from the U.S. that we're not transitioning to renewable energy.
Yep. Okay. Very good. Thank you. Okay. Let's move on then to another key point, and Matt, you touched on both, and I'd like to just sort of split them. Firstly, the capital availability question. Very interesting, your point around what's being allocated in the downstream versus what's coming upstream, where these materials are needed. And we all know, and we always talk about lack of capital going in to the projects and the turnaround time for getting raw material supply on. But I just wanted to sort of focus in on that and get the panel's views on whether things have picked up in that respect, with the advent of OEMs, automotives coming in and taking more offtake deals, some of the acquisitions that the larger mines are doing, thinking of Ganfeng and lithium, for instance. It seems like with the prices improving, there's a bit more incentive now to sort of tighten the value chain and see more capital flows coming into the sector. Would that be right, though? Marcus, could I get your take?
Sure, and I think undoubtedly we see additional capital flowing to the to the materials and the mining side of things. Let's not forget this is on the back of a great sort of crisis in the mining industry that we saw over the past 10 years, where a lot of the large investments that were started or were supposed to start, did not materialize. So, already there was a structural gap in these markets even before the very strong demand from EVs. And bridging that gap today is not an automatic process. Certainly, we see a lot of money coming into the field. I think this is good because it allows existing operations, brownfield operations, and even greenfield projects to get off the ground. But as Matt mentioned earlier, the timeline from conceiving a project like this to actually having product in the market is really a long it's a long process. And I think the capital going in has to be conscious of the long-term element of that investment and the price volatility that also comes with that space.
Yep. Certainly. Aline, could I also invite you to comment as the other on the private equity side or the hedge fund side?
Yeah, I think it is improving. I think we're seeing the first essence of more deals coming, both on M&A announcements on the miners of getting some of these backlog projects running. And I think there's three main macro background that helps us. So the first one is inflation. A lot of people, focusing on the schematics of supply chain and inflation. So people opening eyes for both commodities as a category, but also the underlying, need of investment in this sector. The second one is an awakening that I've seen very recently on the ESG side of things, that writing off an entire sector might not be, beneficial for society if we need a sector to do, what we want in decarbonization. So I think it doesn't make sense to say that you write off, mining from your mandate, but you support electric vehicles. How does that pair logic? So there's a little bit of more questioning coming into place. It's like, why are we doing this? And we'd rather do this in the best way possible than not do it and not create the electric vehicles. So I think that's number two. And finally, number three, more comfortable with the quality of these companies that are underlying, slowly, getting a little bit more comfortable with the sector in that sense of management as well. I think that third party is still not there because people are very conscious of the value, destruction that happened when commodity prices went down, and there were over investments. But slowly we are, I think, recovering from that. And I think sector specialists are very bullish. So everyone that is already there, the few of us that survived through this decade, are very, very, very bullish and investing in this.
Yeah. So, but it still falls very much on you and Marcos, Matt, Westbeck, and other Traxis, of course, to provide that risk capital. Seems that these recognition and the developments in the ESG discussion, as you mentioned, is slowly getting there, but it's still, am I right in thinking it's still taking capital off the table for the sector as a whole for so long that we're really, a little bit isn't quite enough yet. We need sort of masses of generalist capital to come back in. Would that be fair?
I think so. I think we passed through phase number one, which is the derivative. The second phase, we are no longer losing capital.
Okay.
First positive, because we've been losing capital every year for a decade. Yeah. So we're finally, I believe, stabilize our capital, and we're slowly preparing for the phase of going up.
Yeah. Just to add to that, hopefully we are reaching the perhaps the hockey stick of investments going back into the upstream and midstream, because the numbers are humongous. Just take the capital for 1 million times LCE of lithium. It's like $25 billion of investment. You want to have at least half of that coming from equity somehow. Go with each of the materials. We're talking about something that's pretty much the Biden bill for the next decade, which has to come with some sort of a joint effect. A joint effort from the private sector, from the financial sector, from the government, etc. But we have seen things. We have SPACs that that are investing and providing some solutions, which have worked. At least for life cycle where we invested, it looks like with a magic wand, you're taking a project into production, not necessarily through the excruciating phased way of doing so. So you have the opportunity to leapfrog if it's done properly. We are seeing green loans, whether it's the IFC, World Bank providing them, or commercial banks like Societe Generale dispersing them, which is also important. And we did say, a few. We saw that Ioneer got a strategic partner now in Nevada with Sibanye-Stillwater that definitely know how to mine and understand the upstream. So it's a real strategic. It's not a Trojan horse strategic. Mm-hmm. And we've seen Iron Ridge, and we've seen who else was there on lithium, Vulcan, and Sigma. So we are seeing things moving forward. I hope we do whatever we can. Just like Paula and a lot of you. We invested in Vermont Graphite and then as to lithium. We're investing now with our partners at Pallinghurst in their most recent project, the Talon Nickel Copper Mine. And, so we're doing upstream, we're doing midstream, we're doing recycling with light cycle, with our own company, Bricks Metallurgy, which is a cleanup and agglomeration company for the ferroalloy sector. If we just, like I was saying earlier, it's a bit of a Kaizen effort. If everyone just does his piece without thinking too much about will it be enough, I think overall the aggregate effect will be substantial.
Yeah, interesting. Yeah.
I would just raise one note of caution, which is that a lot of the capital that's coming into the space at the moment is coming from China. And if we're serious about setting up a European value chain, a North American battery value chain, then we need to see more of the investment coming from Europe and North America to tie up these what are going to be strategic projects. And we're just not seeing it at the moment. So, the North American and European entities in the cell manufacturing space, in the auto manufacturing space, need to start thinking about deploying their balance sheets and deploying their balance sheets quickly, because otherwise we're going to have a bit of a problem in the Western world, because all of this material is just going to keep going through China, which doesn't really help any of the domestic industries for cell manufacturing and auto manufacturing.
Are they not?
And Adam, just to say to that, Matt, I totally agree with you on that in terms of, and what I actually think is that Western OEMs, as part of this effort, should start thinking of themselves as funds of funds. And instead of all this discussion, if, should an OEM own a specific mine somewhere, and, all these things that are so remote from their skill set and how they operate and how they work, if they would just take a piece of, not even a huge chunk of their transition budget and just disperse it to 10 private equity funds that each of them will seed 5 to 10 projects. And even if just half of them succeed ultimately and push into the supply side, it would make such a huge difference. And the fact that, some of them created their own internal venture companies that are invested in technologies that they feel comfortable doing, they're talking, and some of them slowly moving to some downstream, to some sort of midstream. But if these OEMs, the Western OEMs, would actually go in as limited partners into private equity funds that have the skill set and have the deal flow and know how to take these projects forward, the supply side could be substantially stimulated. And by doing that, you don't need any preference, you don't need any co-investment, you don't need nothing. Just help seed the supply side. And while you're doing that, you'll probably make a hell of a lot of money because of all the things that we spoke of. And it's really disappointing that it hasn't happened so far, because I think it's a no-brainer for these OEMs to
It makes sense to all of us. It doesn't make sense to them. But
I don't know why.
If I was an OEM, I'd much rather pay the cost of producing lithium or the cost of producing nickel rather than the price it's going to be in the market, because realistically in 3 or 4 years it's going to be multiples of the current price. And I just don't think that the OEMs are thinking that far ahead, which is going to be a big shame for them.
What do you think's holding it back, though? It seems a no-brainer for us, as you say. They've got to be in a rock and a hard place in some respects, because certainly the ICE incumbents, not Tesla and the EV companies, but the OEMs that have completely deconstructed and then rebuilt their business, really. What's holding them back from jumping into mining? Is it just that we haven't had enough years of the two sides being close enough together? Expertise gap, risk capital again, maybe they're too stretched as it is?
I'll let my colleagues answer that, but make no mistake, I don't think that the OEMs should own mines like Henry Ford and Thomas Edison owned rubber plantations. Yes. What I think they should do is help stimulate the supply side in a sensible way that avoids actually the specific risk of a specific project. And they could do that by acting as funds of funds.
Yeah, I think it's maybe a bit unfair to assume that the OEMs aren't considering the supply chain at all. It's a complicated value chain. And I think that was one of the points I wanted to raise on, where the capital is going. Yep. We talked about the two extremes, the EV side and the mining side. You know, hardly a day goes by where we don't see a new battery gigafactory announcement. You can't miss them now. And that's China, North America, Europe. Okay. But what we don't see so much is announcements further upstream in terms of, you know, anode facilities, cathode, manufacturing, electrolyte, separator. These are the parts of the value chain that seem to be still getting overlooked too, as well as further upstream at the mining level. At Johnson Matthey, we're of course trying to fill that gap at the cathode level, but you know, we still see a huge supply gap, particularly outside of China. So the motivation for investment is there, but you know, it just needs to be put in the right places and at the right time, as the panelists have alluded to as well.
Yeah.
I think the other thing to be aware of with the OEMs is that they're not used to dealing with immature industries. An OEM is used to dealing with mature industries like the steel industry, etc., where they can just turn around to their supplier and say, look, I want another 10,000 tons of steel this month, or I want 10,000 tons less. And I just don't think that they've quite got their head around how immature this is as an industry. I think it's going to start, but for the time being, we're not having the pass-through of high prices into the supply chain. I mean, we're all aware that, for instance, spot lithium prices in China have gone ballistic, but how much is that actually passing through to the supply chain in terms of tier one cell makers, most of whom are in annual or long-term price contracts, who are not actually seeing that pain and therefore not actually passing that pain along to their consumers. So, you know, it's going to take a while for the OEMs to start feeling that pain. Tier 2, tier 3 cell makers, they're feeling that pain. But most of the big Western world OEMs are locked up with tier 1 cell makers, and they're not seeing that sort of price increase at the moment. So it will take a while before it starts to maybe concentrate the minds a little bit more.
A while is not so long. It's a year. What will happen next year? Really?
Yeah.
Like, we're looking at next year, exactly those countries that are mining, and go back to inflation point, right? That will come into the supply chain really hard. In that fight at the OEM, I think there's also the question of the uncomfortableness of dealing with the volatility of these commodities. I think, you know, historically, OEMs are really good in operational efficiency. When you go into, you know, putting your job on the line and investing in nickel, and you see historically the price of nickel has been anywhere between 50 and 6. It's a hard thing to underwrite, right? It's uncomfortable. We know how it is in the sector, but outside of the sector, not so easy.
That is very true, Alina. I agree with you, and I think you know, price volatility is certainly an element that is harder to digest as you go up the value chain. Also, you know, these mining projects, you know, they start you know, from a sort of from an exploration stage to a pre-feasibility study to feasibility study, and I know Matt has alluded to that in his papers and other comments. A lot of money is going into projects that may or may not succeed in actually producing any material that will be usable in any form. Or some of the projects that are existing may end up producing at such a high cost that you know, they really depend on high material prices to be viable. So, you know, I think that's a challenge also for OEMs or any type of company that is not in this field, you know, for a very long term, to digest the evolution of a mining project, and then going into the challenges of production, which you know, by no means in my sort of 6-7 year experience in the space, it is a given, regardless of how much money you spend on designing a project with the best consultants or best you know, best engineers.
Like part of the issues of bridging the time gap, at least on the upstream, not on the conversion. Conversion, of course, you can spend hundreds of millions of dollars into what seems to be a perfect conversion plant, and it just doesn't work. And then you start pouring more money into tweaking it and fixing it, and it's this could definitely be an issue. Although it does seem that at least on the elements going into the cathode and the anode, most efforts have been successful. But one of the things that would potentially could help to bridge this 10-year gap, let's say, from if not more, from discovery to producing the ore or the concentrate, is going back to tailing ponds and to dumps, and things like RTR in the Congo, but there's also Elementis in Louisiana, and there's a lot more. There's a lot of extracted material that was extracted not so efficiently because no one cared so much and was just looking for one specific element from 100 or 150 years of rather intensive industrial activity since the Industrial Revolution. And perhaps some kind of a more focused and concentrated effort on these type of solutions could leapfrog us a little bit to the point where you're just figuring out what's the best flow sheet for extraction. And the same goes for adding some of the products as byproducts. I had a couple of interesting meetings with a company called Compass Minerals in the United States that has that works in the Salt Lake in Utah, and they've been producing a little bit like, I guess, the Dead Sea operations in Jordan and Israel. They've been mining the lake for potash, for salt, for magnesium, and it turns out that there's lithium there in the brine that was just sent back as part of it wasn't in the flow sheet. You add it to your flow sheet, and and suddenly you have the greenest and the most ESG compatible lithium of all. And there's a lot more examples of that. So I think this is also something we should consider, especially that we see now that everything is new. The upstream, the midstream, it's all happening in once. It's not that we're just redesigning something and using well-established supply chains. So that has its challenges, but we also see that recycling now is happening hand in hand with primary and not in 50 years of delay. So since it's on the agenda everywhere, everyone is aware of it. Maybe in addition to our thoughts about end of life or industrial or production scrap within the cell manufacturing, we should also give a lot more attention to scouting all these dumps and ponds and mountains of tailings that we left around the world, and see if there's value that could be extracted there.
Yep, it's a fair point. That closed material loop as well. Okay, unless anyone's got anything else to add into that moment, we've got about 12 minutes left. A couple of good questions came in, and I want to frame them with what we wanted to cover before. So coming back to some of the ESG questions, and Aline, you raised this as a good point, that there's a sort of a reconsideration almost going on within what ESG means and how the ESG conscious capital could look at mining with a long-term view, provided it was the right projects. I just wanted to ask whether ESG's got the potential to slow the energy transition or really accelerate it, and also maybe shed a bit of light on this concept of sort of not of some funds posing as sort of very ESG conscious, but they're not willing to invest in the raw materials, but they would perhaps hold a position in Tesla, or which is a very different proposition in itself. Why invest in EV equities, but you wouldn't invest in a lithium mine, for instance, provided it was doing all of the right things in terms of ESG, or indeed trying to produce zero carbon lithium, such as some of the DLE prospects that we've seen out there. Just wondered if anyone's got any comments on how the ESG piece is moving and whether it's going to help those capital flows or slow them down for the battery metals miners.
I think it's going to be challenging. At JM, we're fortunate enough to, have secured what we would consider ethical, sustainable raw materials for our facilities going forward. But there's not limitless amounts of that material out there. So we're not only talking about a market where supply is going to be very tight for the foreseeable future, but some of that material that's available won't meet some of the OEMs' ESG criteria. And we know that without that and without meeting those criteria, you won't even get your foot in the door. So it remains a question, and actually it is a major risk. We could very much move quickly in terms of EV adoption, but are we going to do that at the expense of poor mining and not so ethical mining practices either? It's going to be a tricky balance, and that's why we think things have to happen a bit more gradually, give the supply chain a bit more time to mature.
I think this is exactly the sector that we're most bullish. If you look at these materials in general, they are quite tight in general. If you look at clean sources of these materials, these are extremely tight from markets from here to the foreseeable future. So you cannot, I don't know how you don't get bullish clean nickel, knowing that eventually carbon price will hit the nickel markets. Clean alley, sources of cobalt that are certified. I think these are all very, very, very interesting investment opportunities. And this is the time to invest this now, and it's really, really a market that has strong fundamentals, in my opinion. This one. And the second one is you need to put into your calculation higher ESG requirements in these operations. This will come at a cost. Mm-hmm. So what we do is that we take a look into what pre-feasibility, feasibility study, and add a very good chunk of operating at a higher standards of environmental criteria. We'll push the cost curve as well higher.
And who's paying for that cost in the end? I guess is a bit of everyone. Is it you when you're acquiring or taking majority positions? Is it the OEMs? Is they're procuring that end product? Are we seeing premiums on sustainable supply yet coming through?
I think it's already coming through on the physical market. Premiums for better quality brands. I think that that division between clean and unclean material will only increase in the future. So if you're in this sector, it's quite bullish because you're going to get the price and the premium that comes with it.
Yep. I think it'll push the cost curve up. I mean, if you look at, for instance, a steel plant with CCS, so carbon capture and storage, the operating cost is about double what a normal steel plant is. So it's going to push the cost curve up, which obviously will push prices up for the consumer as well. But I mean, just in terms of the ESG investment, I think over the last 2 years, we've really struggled to attract ESG funding into the sector. And that's one of the things that really has to change. It is changing a little bit at the edges. We are starting to see some ESG investors start to look at the sector now, but we need to see more of them, and that's really just a communication. It's an education. It's just a long-term thing that we've just got to market the sector a little bit better. We've got to ensure that people understand that it's a closed loop, and if you don't invest in raw materials, then you're not going to get the EV and the low carbon future. So unfortunately, there's no easy fix. It's just a long-term education story, really.
Okay, we've got about 5 minutes left. Erez, if you can give it a quick.
Yeah, just one sentence following up on what Matt and Aline said. I think that for ESG investors, actually the opportunity to take part in, I guess, nothing short of revolutionizing the mining sector is a wonderful opportunity, a wonderful investment opportunity. I mean, there's a lot of potential and a lot of money to be made for ESG investors if they if they participate in this. So I think it is a matter of communicating. It is a matter, first of all, on the popular level, to explain to people that these materials are coming from somewhere. We just need to make sure that they're produced ethically and safely and in an environmentally conscious manner. And for those that are investors and are investing in green fabrics, in vegetarian alternatives, and everything that has to do with non-mining ESG, I think that onboarding them to this opportunity and to the ability to make money and to actually make a real impact, because it affects everyone's life, is something that we have not been able to communicate so well, apparently, and we should do better, and we should onboard these investors so that we can bridge this gap between the underinvested upstream, midstream, and the heavily announced and invested downstream.
Yeah, I agree with Eris. I mean, this is something we see as well. And there are opportunities where ESG investors can be brought into these projects, even on, let's say, more micro level, on adding renewables to mining operations.
Yeah.
Even if they don't see or they don't want to be exposed to the whole picture, there are elements where they can be brought in, which allows them to be more familiar with the whole organization. And last thing, ESG is E, S, and G. The governance part is important, and maybe it's the, let's say, cheapest to implement. But we shouldn't forget that. Building good governance in our businesses is something we really need to work on, and it just takes a good framework and a good, let's say, support from top management to have that implemented.
Very good, very true. Okay, look, a couple of minutes left. I wanted to go around the panel and just say, okay, we've done the challenges piece, we've done the very optimistic views, but what are we investing in now? Where's the opportunities now, and what do we like? So just quickly, if anyone could summarize their take on, where the best opportunity in battery metals is at the moment. Is it obviously a diverse portfolio, but is there a lot more value to be and gains to be realized from junior lithium explorers, for instance? Let's quickly get a take there. Does anyone want to kick us off? Matt, we spoke on this just the other day. I'll pick on you.
I get the hospital pass. Okay. I would say for now, given the momentum that we're seeing in prices, I would go for lithium, primarily because we already have a very material supply-demand deficit. My view is that we're already in a deficit market now, and that we will remain in a deficit market for the next 2 years. So I think lithium prices will go in one direction. So for me, I would be looking at lithium at the moment.
Yeah. Aline, maybe there's not simply a case of just picking a commodity, but it's very project specific. But where is Parliament and your hedge fund most interested at the moment? You've been positioned in nickel, various other projects.
Yeah, I like, obviously, the whole complex looks really interesting in copper, lithium. But if I were to pick one, it would be nickel outside of Indonesia. I quite like it. I think the demand, it is a hockey stick. And trading the carbon futures as well, and understanding the carbon markets, I think is a reality that this is going to come in sooner rather than later. And if you have clean nickel production, I think it would be really, really interesting. Take a look.
Yep. Marcos, I'm sure you wouldn't disagree with that. Heavily involved in some nickel projects upstream and downstream.
No, I wouldn't. And the nickel side is where I can really comment. For me, the interesting thing I'm working on now is seeing how to bridge some of the resources that exist around the world that are available or are untapped, to bridge that with existing production facilities in different parts of the world, where infrastructure can be developed faster and you can have material produced faster, even though you might have to invest in the logistics elements of moving materials, but it would be a faster go-to-market while you take the time to build capacity in the locations where the resources exist.
Yep, fantastic. Milan, maybe I won't ask for you, where you're sticking your capital, but certainly where do you see, if you have any projections at JM around the price increases that might in turn hit on the share prices of some of these mining companies?
I think I'd just say, let's make sure we don't forget the cathode space. It's very critical, often gets overlooked. And I think when we're talking about market balances, I'd ask everyone to have another look at, how much cathode capacity is going to be available in Europe and North America, for example, versus how much will be required.
Yep. Erez, could I get your view as well? What are you investing in now, if you can say, or just the same?
As a narrative, and again, of course, the whole suite of materials is extremely relevant, and as well as the technologies that enable it. And but if I had to take a kind of a step backwards, I think that investing in a let's call it pan-Atlantic supply chain, ideally also incorporating Africa, which can go either way, into this supply chain. And I don't want to. It's economics and not politics, but sort of creating some sort of a NATO of a supply chain that can really enable the growth, both on the electromobility side and on enabling the transition to renewable energy, and actually funding all these trillions of dollars of investments that are required, in the next few decades as we move along, is very important. So there are opportunities across the board. We invested, in New Vermont Graphite, Nemaska Lithium. We're investing now with Pallinghurst in Talon. We invested in Light Cycle. This is all North America, but we also have, activities in Europe, and we have activities in Africa. And I think, for example, if you manganese is sort of a neglected and somewhat forgotten element. So, producing high purity manganese sulfate without roasting, ideally, in a hydrodual metallurgical manner, is something that's quite important. Copper, of course, it's hard to go. It's going to be hard to go wrong with copper in the next few decades. And there's definitely a lot of work to be done there. But we're more than being bullish on a specific metal or a specific technology. We're bullish on the narrative of this pan-Atlantic part of the world catching up with the great work that was done in Asia Pacific by China, Japan, Korea, etc. And there's also going to be, of course, a higher level where everything is hopefully global and connected. And everything that we were hoping for, and the end of history, etc., will hopefully actually happen at some point. But in the interim, the pan-Atlantic supply chain, at least for Western investors, I think is the way to go.
Excellent. It's a really good forward-thinking perspective there, pan-Atlantic supply chain, and a good note to end it on. I'm conscious that everyone's got their Friday nights to get off to, and we did agree a hard stop. So I will end it there, but I'd just like to say tremendous thanks to my panel, Milan, Matthew, Aline, Erez, and Marcos, for giving your time and views. Thank you very much. We'll make a replay of this available for those of you who might have had to tune in late or dip out early. So thanks, everyone, and have a great weekend.
Thank you.
Thank you. Thank you. Bye, everyone.